Good morning, welcome, and thank you for joining us for this portfolio update webinar on the TB Amati UK Smaller Companies Fund. I'm Colin Thompson, one of the sales team at Amati, and updating you today we have Anna MacDonald, Scott McKenzie, and David Stevenson, with Paul Jordan and Gareth Blades joining them at the end for the Q&A session. Later in the presentation, David will cover the market backdrop and the outlook for UK equities. Scott will focus on portfolio positioning, portfolio metrics, the style characteristics of the portfolio, and the activity. But first, Anna will look at performance over the last year, covering contributors and detractors. So we hope you'll find it a comprehensive and informative update. Importantly, though, the BrightTalk platform offers a facility to submit questions to the team. So please enter your questions on the webinar page as they occur to you, and the team will pick them up at the end. And with that, I'll hand over to Anna.
Thanks, Colin, and good morning, everyone. Here we can see the funds under management, just as a bit of a recap. You can see that the Smaller Companies Fund still makes up the bulk of assets under management, but also that our TB Amati Strategic Metals Fund, which was launched just over a year ago, has been growing nicely. And I hope that next time we update you, you will also see represented on here the Strategic Innovation Fund that's also recently been launched last month. Now to come on to performance. I'm pleased to say there's been a considerable turnaround in our relative performance since we last spoke. The markets have been weak, as I'm sure you're aware this year. We have outperformed the benchmark, and this means that we continue to build on our long-term performance record. I'm going to take you through the main detractors and the main drivers of performance, and then I'll hand over to Scott, who will talk to you about really how we've been reshaping the portfolio to try and adjust to what we've really seen as the changing investor sentiment now that we're heading into much more inflationary times. The portfolio contributors over the last year. Now, you're probably, a couple of things I guess will strike you when you look at this. Energy stocks are 6 out of the top 10 on this slide. And then also we've got 3 stocks that were or are currently bid targets. If we look at the biggest contributor performance, that's i3 Energy. It is also now our largest holding. We think it remains a really strong company in a very important sector. We picked up shares in July 2021. And I think if you look back to that, you'll remember that that was in the run-up to COP26. And there were a lot of investors turning away from oil and gas stocks. And it felt to me, or felt to us, like it was almost at peak ESG. We completely support the transition to renewable energy sources, but we don't believe that you can turn off oil and gas overnight. And I think this has been thrown into horribly stark relief by the actions of Putin and the stranglehold that we can see that he has over gas and oil into Europe. So we think it's important to have sources of oil and gas and support those sources in jurisdictions which aren't run by tyrannical regimes. So all these stocks on this slide would fit into this. i3 Energy is they place shares last year to fund an acquisition of some really good overlapping assets and pipeline in Canada. And Canada is definitely a jurisdiction we can live with. There's other energy stocks on here, but I'd highlight Serica Energy. It produces around 5% of the natural gas requirements of the UK off the coast of Shetland. And just as a point of interest, it might surprise you to know that Serica ranks lower on Refinitiv's ESG scoring than Gazprom and Rosneft. That kind of thing doesn't make sense to us. And it means that there are opportunities to buy companies which investors, for the sake of perhaps screening or whatever, have been turned off buying oil and gas stocks. From the takeout targets, we can see there's Sumo that was bid for by Tencent, who valued their video gaming capabilities. they continue to do, but unfortunately not in the public market. Develop video game development and art studios, a very, very good company, which we are sorry to see go. HomeServe was actually quite a recent holding, and we felt that the shares had been derated. They had pretty solid UK performance and lots of opportunity to go for in the US. Private equity clearly felt the same thing, and they have now bid £12 per share for the stock. And CareTech is currently subject to a management buyout and has been another strong performer on here. Now to the detractors slide. On the left-hand side, the biggest detractor has been Renalytics. Now, I think we've learned quite a lot through this holding in Renalytics. It was a very strong contributor for us, and I think we've all learned that we should probably have taken some profits, as it was a big component of the fund, because the market sentiment really did turn towards loss-making companies during the end of last year. And when it had some news such as delays in FDA decisions, delays in reimbursement decisions, that really hit the shares. And we have exited that position. We've also exited Sensign Health. There was a kind of an unsuccessful sale process for the business, and then they required more financing, and it was an unhappy story, and we have exited that. We exited it in January 22. But all the other stocks, we've actually carried on holding, and we do continue to see really quite good value in them. On the left-hand side, you can see Gear for Music and Victorian Plumbing. They did come off very strong sales during lockdown, because these are two e-commerce plays. And so the shares are very weak after their profit warnings, but we still think there's opportunity there. HiQ is an excellent company with some really interesting technological IP. They have been hit by some supply chain issues and some shortage in chemical supplies, but we think that is a short-term issue, and they'll be able to pass on cost increases to their clients and be able to recover. Ascensus, we took in a placing last year, and this was a placing to build their growth opportunities. That they see a big runway ahead. Now, the market was feeling very nervous when Ascensus had announced that there were delays from some of the landlords making decisions and signing with them. And the market was really very fraught by that stage, and anything like that caused a dramatic fall in the share price. In fact, those delays are no longer, and landlords are now signing contracts again. So we're really pleased that we kept the holding and, in fact, added to it. Alpha Wave suffered from, it suffered from being a recent IPO, and despite delivering really strong earnings, bookings, revenues, and earnings expectations, they have been subject to some quite extraordinary behavior, I suppose, in the stock market, with short notes and very savage articles written about them. And we have spent a long time talking to management and got ourselves really comfortable with the business, and we think it offers something extremely different in the market, and is a very high quality tech stock. The other three stocks on the right hand side, stocks that, and I know Scott's going to come and talk about this, that have really been derated without seeing an underlying deterioration in their earnings profile. So we've been adding to those and very happy to do so. So I'll hand over to Scott.
Thank you, Anna. The following slide just gives a quick snapshot of where the portfolio is today and some recent history in terms of the assets under management. The fund size today is 840 million. And if you look at the chart, the grey bar shows where we were at the end of 2019, approximately 400 million. So the fund size has clearly grown substantially in the last 2.5 years. And we saw quite significant inflows in the latter part of 2020, early 21. Despite that, we haven't changed the process or indeed anything that we do with regard to managing the fund. The number of holdings today is 73, so that hasn't altered materially during the period. And we typically hold between 70 and 75 investments within the fund. Probably of more interest in terms of demonstrating the consistency of process is the weighted average market capitalisation of the fund, and that's shown in the red bars here. So our average market cap is just under £1 billion in the fund at the moment, and that really hasn't changed at all despite the rise in the assets of the fund. So we're still very much fishing in the same ponds as we always have done, and really the message is that the process remains absolutely as it has been over many years. And just to illustrate the point with regard to the market capitalisation, the smaller companies fund is designed to have a waterfront coverage of the bottom 10% of the UK stock market. So we have a wide variety of different companies within that, both by sector and by market capitalisation. What we're not is a microcap fund. So the small grey bar at the top, we have about less than 5% of the fund is under 100 million market cap. So microcap really isn't our your kind of core competence. Where we think we add the most value is really in those sweet spots above 100 million and moving up to 2 billion. So giving us the average market cap of about 1 billion. The other end of the portfolio, as shown by the yellow pie, we have about 19% of the fund out with our benchmark. Just to remind you that our benchmark is the Numis Smaller Companies Index plus AIM. And the rough cut-off point for that is just under £2 billion market cap at the moment. So we have about 19% of the fund, which is above that market cap range. And thankfully, some of those tend to be companies which have grown into that. And we do believe that we should give scope for our companies to grow in market cap over time. They also provide some useful liquidity as and when required. So if we combine those larger companies with our cash of just under 5%, approximately 25% of the fund we would regard as highly liquid. Final point, just at the bottom of the slide, some of you will be familiar with our venture capital trust. We have about 8% of the smaller companies fund has benefited from companies which have been promoted from the venture capital trust. So still a very important part of the portfolio going forward. In terms of the sector positioning of the fund at the moment, the chart in red shows where we are at present, and the grey bars demonstrate where we were 6 months ago at the end of November. We are a very diverse fund. We tend not to exclude many sectors. Anna gave some very good examples a moment ago in the energy sector, and we find many funds have gone away from that sector and quite often have zero weightings. We've actually had as much as 10% in energy up until quite recently, where we have taken a small amount of profit. But you can see really looking at the slide that there's a broad church within the portfolio, and that is a very deliberate and diverse portfolio. Information technology is still the largest part of the fund. Despite the sell-off that we've seen there, we are still finding good opportunities to add to some of our existing holdings. The healthcare segment has come down slightly over the past year. We have divested of some of the loss-making earlier stage businesses in that sector, but remain committed, to the more profit-earning mature businesses that we do own there. So overall, it's a very broad and diverse profile by sector, and there are no major sector outlying positions that we would take. Looking at the portfolio valuation, this really has moved quite some distance over the past 6 to 9 months. And the data source we're using here is the Canaccord Quest system. It's a database we've subscribed to for many years, and it gives us valuable insights not into both the portfolio but also into individual stocks. So it's quite an important analytical tool. And we assess the portfolio on a regular basis using this tool. And really what we see on the left-hand column, the fund does at the 31st of March. Those are some of the valuation metrics that we're currently showing. The middle column is the Quest UK Small and Mid universe, slightly different from our Numis benchmark, but a reasonably good proxy nonetheless. And then on the far right, we show the fund as it was last September when market conditions were clearly somewhat different to what they are today. And I think what we've really been focusing on in the fund is making sure that our valuation metrics are robust in a weaker market environment. So it's quite pleasing for us to report that in a number of the traditional metrics, such as PE ratios, dividend yields, and free cash flow yields, we now actually are at a discount to the main Quest small cap universe for the first time in quite some time. So we do feel, that the portfolio has really strong value characteristics have emerged, post this shakeout, and since we've done some recent actions. I'd also highlight the bottom two parts of the chart here. the net debt to EBITDA, our portfolio companies typically hold cash, and at the portfolio level, we have in aggregate a lot of cash within the portfolio compared to the main benchmark. And also encouragingly, we have a very high profit margin across our companies. So EBIT margin, a weighted average of 23%. And we think that's very important, particularly in the current environment where we're seeing significant inflation and potentially significant GDP and recessionary pressures. So we do believe that having companies with very strong balance sheets and very high operating margins will be an essential feature for the portfolio in the months and years ahead. Looking at the style of the portfolio, this is data that we have sourced from Style Analytics, which is a well-established provider of such data and is widely used amongst our peer group. And this really looks at the key kind of characteristics of style, value, growth, quality, volatility, momentum. So all relatively well-established formats of style. And really this gives us a good sanity check in terms of, is the portfolio doing what we expect it to do in terms of style? Is it as we've spoken to our clients about? And I think the encouraging outcome from this is it is pretty much as we'd hoped it would be. So we do have a bias towards growth factors and we're biased towards quality factors. That has been the case now, for quite a few years within the portfolio. And more recently, we've exhibited lower volatility as well. And that's probably helped in terms of the more difficult market conditions that we've seen. So the fund has relatively outperformed in a falling market, which is what we'd hoped to see. And finally, on the far right, the momentum factors are now beginning to turn more positive for the fund overall as well. And that's a good improvement on where we were 6 months ago. So overall, this analysis confirms where we hope the fund will be, a bias towards growth and quality with hopefully slightly lower volatility than the index. Quick snapshot of our top 10 holdings. This is obviously available on the website and on the fact sheet as well. We won't go through these in detail, but the main important point to make here is that it's a very diverse top 10. So these are all quite different companies from a variety of different sectors and sources. Anna's made reference already to i3 Energy. And a year ago, that was a very small part of the portfolio and is now a major investment. But it's encouraging to see, so many different types of company in this top 10. And we do believe that we should be offering our investors a really broad waterfront exposure to the bottom 10% of the market. And hopefully, this demonstrates the diversity in the top holdings. And typically from a portfolio weighting perspective, our average weighting would be about 1.5%, and our largest would be just over 3%. So we're not taking excessive risks at the top of the portfolio either. I'm just going to wrap up with a roundup of some of the recent activity in the fund. So these are some of the companies we've either been buying new positions in or adding to existing holdings. And what we've done here, again, is look at the Quest database. The database provides us with a lot of information on quality metrics and also on momentum and value metrics. And just by way of a brief explanation, they are typically scored out of 33, each of those 3 things. So what we're focused on in the recent purchases are buying quality businesses when they're out of favour. And all 5 examples on the chart here really do conform to that thesis. They're all very high quality businesses as ranked by Quest. And that would include issues such as accounting, quality, return on capital, cash flow, etc. So we believe we're investing in really high quality businesses, and those have been corroborated by the database. They also do a risk rating within the database as well, and that goes up to 100 at the top and 1 at the bottom. So again, all of these companies are pretty much top quartile in terms of their risk rating, i.e. relatively low risk, well-run companies. So in the case of Craneware and Gamma, Anna highlighted them earlier as being detractors. Those have been investments in the fund for a while, and we've taken the opportunity to reassess these companies and indeed increase our investments. So we're happy to buy these high quality businesses when they become out of favour. Kinetic is a defence business, and I guess it's been controversial over the years. It's been very much out of favour from an ESG perspective. We've been steadily increasing our holding over the past 6 months there. Again, we believe it's a very high quality company, and the recent tragic events in Ukraine, have made that altogether more valuable holding. So it was an attractively valued business and a high quality company, which we have added to. Ditto Spirent, again, a very high technology company with really good earnings progress. And again, the shares had suffered in the NASDAQ sell-off that was seen, and that gave us an opportunity to make that a larger holding. And finally, Rathbones will be well known to most people on the call, obviously within our own wealth management industry. Again, we saw this as being a very high quality business, very lowly valued indeed. And we took the opportunity really to build up a position beginning in the middle of last year in this business when the shares were very lowly valued. And we saw the recent bid for Brew & Dolphin, and that really highlights the significant valuation anomaly within Rathbones. So overall, we are buying, what we regard as high quality, high growth businesses, hopefully at very attractive current prices. In terms of what we've been selling, using the same Quest database, we've zeroed in on the value scores here, and it's the same type of analysis. They're done out of 33, the value scores, and it became apparent to us towards the end of last year that we had a number of very good companies in the portfolio which had performed extremely well, but were also looking very overvalued, and the group of companies on the slide really were within that criteria. It's important to say that these are all very good companies, and we may well revisit them again in the future, having known them very well already. But in each case, the valuations we regarded as being unsustainable, and they had very low value scores within our database. So all of those companies have been exited, and with the exception of Oxford Instruments, most of them have fallen, reasonably significantly since we made the sales, and that helps explain why some of our valuation metrics have improved at the overall portfolio level. We've sold, some quite expensive holdings and bought some relatively modestly valued ones. So with that, I'm going to pass over to David, who will take you through some of the key themes in the markets.
Morning, everyone. Yeah, as Scott says, I'm going to go through a few slides which highlight the sort of market messages that we want to leave you with in terms of where we stand currently and what the outlook might be. The slide again is driven by Quest data in terms of the Quest analysis of quality companies, which Scott's already gone through. This analyzes the top quintile, top 20% of ranked quality stocks within their database and how those have performed as a grouping over the very long term. So we're looking here at 20 years plus, and a fairly consistent picture, which evidences the long-term outperformance of quality, which essentially drives our process. And we're using the current environment where quality has been derated, as we mentioned earlier, to either add to existing positions in the portfolio or add new ones. This is a graph from Liberum this time, which analyzes the UK market into two styles, value and growth. There's been a lot of debate about that more recently. This is going back over the last 3+ years, and what it shows is that in the lead up to the announcement of vaccine trial results at the end of 2020, very consistent, reasonably consistent picture of growth outperforming value as the market focused on sort of healthcare and technology and online e-commerce type companies. But the moment at which the trial results suggested that the pandemic could be dealt with and that there was a prospect of an economic recovery, a very aggressive derating of growth and switch to value, which, given mean reversion at any point in time, one could have anticipated or accepted. But what surprised us is the degree to which value has continued to outperform and the derating of growth. We are at the moment seeing a bit of a leveling off. It's almost too small to notice on this longer term graph, but we are seeing some of our growth names where the share price selling pressure has eased a bit and the share prices are flatlining. but more importantly, a lot of the names in that space, if they announce very positive earnings momentum news, which is the reason why we hold these stocks, that the market is returning its attention to them, and we are seeing some good relative share price outperformance on the back of trading news, which is essentially what we see as a reversionary process. And if that does build significantly across the market, then there's clearly a long way for growth to re-rate relative to value, given its recent performance. The slide shows where the UK market sits internationally. Well, the main comparators, US and Europe ex UK, on a sector adjusted forward PE. So this takes account of the fact that in the US, very significant technology weighting, obviously. This zero bases that, and this shows that even with a significant sell-off in the US, the UK still remains cheap, more in line with Europe than it has been for a while, but both markets looking cheap. And then within the UK market itself, very notable over the last year, the degree to which small mid caps have underperformed large caps. So in an overall cheap UK market, we have an even cheaper scenario for mid, small, and AIM. That significant outperformance of large cap, as we all know, has been driven by the sector mix within the FTSE 100. The predominance of large pharma, large oil, large banks, and large utilities, and that's been right and proper, I think, in the uncertain outlook that we've experienced over the last year. Less, I think, visible that those same four sectors will continue to be by far and away the best outperforming sectors in the UK market going forward. It may well apply to large oil, but we think there is a significant scope for a catch up in the smaller companies space, and a retracement of that spread of performance relative to large cap going forward. A very pleasing feature of that degree of cheapness in UK smaller space has been the pickup in bid activity. For a very, very long time, the cliche was for a cheap company was it if the stock market didn't recognize it, then someone else would, and very often in previous decades that didn't turn out necessarily to be the case. Well, it definitely is now. The cheapness of the UK and the cheapness of small mid cap is encouraging bidders both trade and also, more importantly, private equity, which features significantly in the activity that we're seeing. Private equity continues to have a significant amount of dry powder to do deals with. And the interesting thing is that relative to previous decades, their targets are now spread across a very diverse range of sectors. I mean, traditionally, private equity played a lot in the consumer discretionary space, buying leisure companies and retail, which are cash generative businesses, and that allowed them to financially engineer their deal flow. But they're clearly broadening out now into looking at very distinctive, unique businesses across a range of sectors, and we've certainly seen that in our portfolio. Over the last 3 years. The names here comprise video gaming developers, translation services, infrastructure, air chartering, home maintenance, and care services. And each of these are very distinctive businesses, very often with significant market share. And private equity and trade buyers seeing the quality of those businesses. The bullet point at the bottom just shows the degree of step up in underlying bid activity, which we can see continuing for so long as the valuations remain at such a discount. Clearly, that is a double-edged sword. It helps your portfolio performance, but some concerns about the de-equitization ongoing of stock markets and the movement of lots of really interesting quality companies back into the private private space, but that's probably a separate debate. I'd like to finish, given all the noise at the moment about UK GDP, with this slide, which I will explain. It's slightly busy. The first thing to say is the line graph shows quarter on quarter UK real GDP growth going back over 5 years. So the significant things to draw out are the degree to which that was a flatlining trend in the lead up to the pandemic, which has always been the issue with UK GDP growth being sluggish relative to the global picture, and unable to break out into any significant uptrend. Now, clearly, the pandemic, a tsunami, just blew that trend out of the water, and the chart disappears off the edge of the axes, both bottom and top, which shows just how unprecedented and unsustainable both those features were, both the downside and the upside. Post-pandemic, with a degree of stimulus and support, we've steadied the ship, but sadly that steadying has happened at what looks like the long-term historic trend, in that we've just trended back to very low positive quarter-on-quarter growth. Just over the last few days, a number of economic think tanks are coming out with the fact that 2023 there is potential for the UK market to flatline, to achieve zero growth. That's a consequence of some fairly particular headwinds that we face within the UK. Consumer spending under pressure, interest rates turning, inflation rising, supply constraints. We have an economy that isn't as flexible as other economies. So all of that acting as headwinds. I'll just touch briefly on the components as well, which are the coloured bar graphs. The things to draw out here is that prior to the pandemic, relatively few dominant influences on UK GDP quarter-on-quarter growth, and then we see a huge increase in volatility subsequent to Q1 2020, with at various points consumer spending crashing, then rebounding, imports crashing, then rebounding, exports again featuring both sides of the graph, and more recently investing by governments and corporates, more governments and corporates beginning to step up. Unfortunately, that creates a picture of no individual factor is going to produce sustainable economic growth from here. The last quarterly data showing investments being the biggest driver of growth, that's essentially government infrastructure, and you can't build a sustainable economic growth picture going forward purely on infrastructure spend. And sadly, the ongoing problem the UK has always had, which is a net trade deficit, that continues to be a drag on our growth as well. So, what comes from this is, yes, we are facing hard yards economically going forward. A return to the normal sluggish trend, plus the additional headwinds that I've mentioned earlier, including taxation. Fiscal take is going up, and that's a headwind to corporate earnings. So you may well justifiably ask, what do you do in that environment? Well, our view is, as always, that individual stock picks are the way to chart through this difficult period. So focus on companies that have their own self-growth drivers. These are the sort of companies that will most likely have strong market shares, and they'll be more likely to be involved in structural growth markets than cyclical markets. So there's a longer term growth visibility to those drivers. They're going to have, as Scott has mentioned earlier, they will have fat margins to allow them to absorb inflation. They will have net cash, strong balance sheets to absorb rate rises, and they'll be able to use that cash to fund their own organic growth and acquisitions to keep the earnings momentum continuing. And those are also, not surprising, the sort of companies that are likely to continue to attract bids, both from competitors and also from private equity. So to sum up our final slide here, As has been said earlier, we haven't changed what we do. The relative performance improvement that we've seen involves the same quality and growth focus. The portfolio itself and the UK smaller companies universe overall has become a lot cheaper over the last 12 months. And I think if investors don't realise that or haven't the risk appetite to exploit that, then other bidders will. So we see M&A activity likely to continue. So I'll finish on that and pass it over to Colin for Q&A.
Great stuff. Thank you very much, David. We have a few questions in, so I think the first one I'll put to Paul, following on from David's presentation on GDP, I think. Was 2017 to 2020 GDP growth due to Brexit? Would we hope that once Brexit settles down, UK GDP growth might be better?
Yeah, thank you, Colin. Yeah, so the Brexit question is always a vexed one, and I fully appreciate that it's hard to sometimes to get one's personal biases out of the way of how one sees Brexit. I mean, I think to try and put cold, hard GDP numbers on an analysis of the impact of the vote, in this is really a guess, but in a kind of rough estimate, I think we could probably say that GDP growth in the UK was around 0.8% smaller than it would have been between about 2016 and 20. We probably lost about, but during the pandemic, after the Brexit was kind of implemented, I reckon we probably lost about 1% this year, 2022. I think Brexit's probably costing us maybe even 1.5% of GDP. It's really pretty painful right now, and I guess one of the it's kind of ironic that in some ways one of the drivers of the Brexit vote was over too much immigration. I mean, we really have pretty desperate labour shortages in many sectors in the UK, and it's affecting obviously some sectors much worse than others, but it's definitely acting as a significant drag on the UK economy. And you add all that up, Brexit's been pretty expensive. Is a kind of that's the cold analysis of it at the moment, and that then feeds through into lower treasury revenues and much more pressure to raise taxes in the UK than there would have otherwise been. So yeah, I mean, the question is obviously saying when this settles down, do things improve? The big question is how does it settle down, and there's still a lot of debate over whether we need to have further changes to the Brexit arrangements. So we keep a close eye on that. But it is, I think, causing the UK to underperform its potential right now, and that's a concern. The fiscal side of it is equally a concern, that we're becoming, the UK is unusually becoming a pretty high tax regime, and that again is going to create a drag on growth. So I'd say we're reasonably cautious on how we see that playing out, and taking account of that in the way we're investing.
Thank you, Paul. We have another question sort of focusing back on Scott's points about the metrics in the portfolio, and I can put this to Anna, I think. How much has the fund PE changed due to turnover position sectoral changes versus the market sell-off?
There's bound to be a bit of both, but what I would really highlight is that the oil and gas stocks, which have become quite a considerable part of the portfolio, are actually still very lowly rated in low single-digit PEs. So that will have brought down the composite PE for the portfolio. So that will have been an issue. And as we've seen, there has actually been a derating in some of the stocks that we've held, and we've added to those and sold some of the. As Scott highlighted, we did also reduce our holdings in some of those good quality but very highly valued stocks, such as Softcat and Genus.
Great, thank you, Anna. You sound quite positive in the small cap sector. Do you therefore plan to reduce the level of cash in the fund? And if so, which sectors will you be investing in and when? Who would like to take that one?
I'll take that, Colin.
Okay.
Yeah, I mean, we typically run with a modest cash balance in the portfolio, usually in the 3 to 5% range. And obviously, in the small cap world, we have to always be mindful of liquidity, and also as an open-ended fund, we have to be mindful of liquidity. But also, it gives us flexibility to make new investments. And in some cases, things coming in out of the portfolio may take a week, 10 days to transact. They're not always things that we can do very quickly. So it's useful to have that small balance of funds at any given time to give us that flexibility. In terms of future investments, we don't have any specific thoughts in mind, but we are a very bottom-up portfolio. You've seen from the sector analysis that there's a very broad spread of sectors and stocks within the fund, and we intend to kind of keep that diversity as part of our kind of core way of running the fund. So I wouldn't really highlight any specific areas. I think that the theme we've been looking at, as we alluded to, is buying high-quality growth companies when they're out of favour. That is a key theme, and I think the other major theme in the current environment is probably finding companies that have got inflation protection, who have got the high margins, and they can put the prices up, to cope with the inflationary times. So those would be the main themes, but I wouldn't highlight any one sector in particular.
Great, thanks, Scott. I think this is a question for David. Where would you expect to see further takeover activity in the portfolio? I think you're on mute, David.
Apologies, you think I would get the hang of this by now. Yeah, as I suggested in the presentation, what we are seeing is a much wider range of targets, particularly by private equity. So, and they are clearly prepared to pay quite high multiples. I mean, one of our holdings in the venture capital trust, IdeaGen, was taken out at quite an attractive premium valuation. So private equity doesn't seem to be adopting the same bargain basement bottom fishing as it has in previous cycles. So that really opens up the whole of the market. But we think that our checklist for the sort of quality companies we want to be involved in are pretty much on their checklist as well. I mean, HomeServe is a good example, a position that we actually only took in the earlier part of this year. It was a company that had previously been in the FTSE, was out with our universe and was premium rated. The market then got concerned about, I think, that valuation. It also got concerned about HomeServe transitioning from being a purely UK, Europe growth story into the future being driven more by what they were doing in the US, and derated the shares as a consequence. So the rating halved from about 30 times to 15 times. And Scott pinpointed that this was an opportunity as it dropped back into our mid-cap, top end of mid-cap universe. Now, life isn't always like this, clearly, but within a matter of a month or so, a couple of months maybe, we had the private equity bid. So, and we would never have thought that was necessarily on the horizon. So, bid activity will crop up right across the market. As I said as well earlier, that is an issue as well, as we see the ongoing de-equitization of public markets as really good quality businesses disappear into private ownership. It prevents not only institutional but private investors from gaining exposure to them. So it's both a good feature and a cautionary one, I think, going forward. But bid activity, we think, will continue on a rolling basis.
Thanks, David. I'll put this one to Anna. How easy is it to manage liquidity and deal in the portfolio over 800 million in
It depends. Sometimes it's easier than other times. What we do to try and be as thoughtful as we can about it is that we are really close to. We keep close to the brokers. We try and keep close to the lines of stock that we know are around, and take advantage of any kind of placings or anything like that to build up our positions or to exit positions. If that's a block trade, for example. And I think by doing that and by being long-term investors, buying and holding and adding, we are able to hopefully build and reduce our positions as we wish. Obviously, in times of real market stress, it can feel quite painful, but that means that we just take our time and be very careful in assessing whether the markets have overreacted or underreacted, and we'll try and act with the best interest of our investors at heart, obviously. So it can be tricky, but we have, as Scott explained, with the makeup of the portfolio, we've got a lot of fairly substantial stocks in the portfolio and quite a large non-benchmark component, which gives us that extra flexibility and that extra ability to be able to adjust to market conditions.
That's great, thank you. And I have a question on ESG come through now, so I'll put that to Paul. Given your exposure to oils and mining, do you think ESG-focused investors should reassess their criteria?
The answer to that is absolutely yes. I mean, I think there's been quite a mistaken view that became very entrenched last year that it's somehow wrong to make new oil and gas investments. For example, while that sort of on a simplistic level sounds, it's drawing a straight line between one place and another. We want to decarbonize, so oil and gas must be a bad thing, so I don't want to invest in it. The problem is that's just vastly oversimplified and overlooking huge dangers of underinvesting in oil and gas while we are so massively dependent on it. And I think we in Western countries just forget all the time exactly how dependent we are on oil and gas until we run out of it. And then suddenly you realize actually we're not going to survive even a week with too little of it. It causes an immediate catastrophe in our economies if we have too little while we're so dependent. What we need is a coherent 30-year plan if we're serious about decarbonisation. And of course, we are, as Anna said earlier, absolutely aligned with the view that we need to decarbonise. It's just that if you make such a fundamental mistake as that, all you really end up doing is make things worse. And a very good example of this came across actually just this week was one of our investee companies, Jadestone, it's an oil and gas company in Asia, and it was been trying to make an acquisition in New Zealand for many years, and New Zealand has a government which, like many here, believes that oil and gas production is just wrong and therefore they should stop it. So this acquisition has been held up by various government departments for a long time, not just for that reason, for other reasons too. And the result has been actually, because New Zealand is now run very short of oil and gas, doesn't have enough domestic production, they've just had a record year of coal imports from Indonesia, and they've started up their coal-fired power stations again. And so, the problem is when you just oversimplify ESG desires, you end up not just with a wrong answer, but with a very damaging answer. So, I don't think it's remotely responsible as an investor to say we're not going to invest in oil and gas. In fact, I think it's actually irresponsible. The right question to ask is, where are you investing in oil and gas? And are you doing anything to stop European dependence on Russian oil and gas, for example? And that's been a question absolutely playing on our minds for many years, not just this year. And I think really, if you've had to make adjustments to your ESG thinking this year, it just shows that the thinking was wrong before, and we really need to do something about that, because actually capital allocation, which is what fund managers do, is a very serious business. And if we start to make bad decisions because of an oversimplified set of reasoning, it really has pretty profound consequences. And unfortunately, we're seeing some of those this year. And I really hope it will bring about quite a lot of rethinking in the ESG debate. And in fact, we're putting on an event on the 27th of June in London, together with Clean Trade and King's College London, to ask the question, how do we break the link between oil and gas and war? And for me, that's the profound question we need to be asking, not should we just give up producing oil and gas, because that just leads to an obvious disaster.
Great.
So
Thank
anyone
you for that.
anyone interested in coming to that, by the way, please do contact us. We'd love to have you along.
Brilliant. Thank you for that, Paul. We have another question I'll put to David. When do you think inflation is likely to peak, fall, and will that provide some momentum for small caps?
Yeah, the prospect for inflation, as ever, the headline number is made up of lots of moving parts that ebb and flow. Inflation and deflationary pressures can coexist within the overall figure. I think, as Paul's possibly alluded to, for structural reasons and a reshaping of global trade flows, it's likely that energy inflation will continue. It will take time for the world to wean itself, or Europe to wean itself off Germany, and albeit that America seems to be stepping up with LNG, but it's likely, I think, that that for structural reasons, oil demand and gas demand will remain high, even if there is a softening of the overall global economy. And I think it's important to say that at the moment, some of the issues going forward are to what degree the global softening will destroy demand. There will be demand destruction, which would lead to a softening of pricing, ability to pass through cost pressure and pricing uplifts across a variety of areas. And I think that will come in consumer discretionary spending. It's already here with us. Looking at the UK on its own, the UK has, I think, a particular problem with wage inflation. We've got an inflexible labour force and not a very mobile labour force. Not UK example, but I was astonished to read just the other day that National Express, operating its US school bus service, was saying that 10% of the schedule they can't service as a consequence of retiring bus drivers and people with second jobs deciding not to continue with it. So 10% of their schedule wasn't working for driver shortages, and they just put through a 12% wage rise for their US bus drivers. Now that is pretty blue collar, and 12% is eye-watering. The companies we are speaking to are a lot of them in the services area are seeing not 12%, but they're certainly seeing 5% plus wage inflation ongoing, and the danger is that gets built into a wage price spiral. But I think there are other reasons why some of the tailwinds will slow if demand begins to fall, both from a household and a corporate standpoint. So just again, using the National Express example, it's very much you have to look at inflation on a company by company basis, which is what we do when we're analysing a company. We have to discuss with them in great detail how are they getting their price increases through, what are the cost pressures that they're facing, and how much to what extent their margins can absorb that. And our focus on companies with established and indeed even growing market shares, large market shares with fat margins, we see that as a protection against whatever inflation brings down the line. It's possibly likely that double-digit inflation doesn't persist, but it's easily to build in a scenario where it's mid to higher single-digit for a period, and only the best quality companies will be able to absorb that. Great.
Thanks very much, David, and thanks to the rest of the team. And of course, thank you to you, the audience, for your questions. That's all that we have time for at the moment, but if any further questions come to mind or you have any comments, please get in touch with one of the sales team here. You can find our details on the website too. So with that, and thanks again, and until the next time, goodbye for now.